Hello everyone, welcome back to my YouTube channel. Today we are going to talk about a very important topic which is very giant. The reason is in bank you always get confused what is IFRS 9, what is CECL. Some of you get very confused that both of them are solving the same purpose, still bank is using both of them. So why it's doing that? How do bank know that some customer may not repay their loan in future, and why do bank keep money aside even before a actual default is happening? So today I'm going to answer that particular question. This is exactly what IFRS 9 and CECL help banks to do. Now, obviously, first thing, let's talk about them individually. Then we'll go to the differences because I do have a file where we'll talk about the differences in a while. But before that, let's try to understand each of them 101. Okay. So as I said that IFRS 9, let's talk about IFRS 9 first. Okay. So let's talk that. So IFRS 9 is what? It's an accounting rule. It's not just a model. It's a rule-based approach which is suggested to all the banks that tells the bank if there is a chances that customer may default in future, whoever taking the loans or credit card, if they can default in future, start estimating those losses. You need to estimate the losses today itself and keep reserve for them. So if your customer can default, you need to make sure that what is a conservation buffer amount you need to keep in your pocket if they default, so that the other people who have invested in your bank, savings account, current account, their functionality should not be affected. So in short, banks try to predict future loans in advance. That's the simple logic here. It's a future based approach which helps bank to keep a buffer. What is buffer? Buffer is the money. Okay. So that is one thing you should always remember. Now, what does IFRS 9 actually do if you want to understand that? So IFRS 9 continuously tracks customer risk time to time. If customer risk is increasing, for example, the customer has started delaying the EMI or the credit score. Okay. Credit score of the customer is decreasing. For example, in India, you have CIBIL score. So if that is decreasing over a period of time, or the customer is having any financial problem, let's say you got to know from customer that they have lost their job. So that is a financial loss problem or financial risk problem. Then the loan moves into different stages as per IFRS 9 rule. That is the whole calculation which we perform in IFRS 9. Now, this staging concepts also makes it different from CECL. Okay. So when I talk about the stages, so IFRS 9 have 3 stages. It always works on the 3 stages. So stage 1, which you have, that talks about if the customer is normal, because this is on the very beginning of the loan and you consider that the customer behavior is very normal. Then stage 2 is something where you identify that the risk of the customer is increasing. Okay, that's what the stage 2 is. And you start calculating the probability of default, LGD, loss given default, all those values you start calculating. Then stage 3, customer is close to default or already impaired. These are the conditions. That's why IFRS 9 sometimes called as a impairment model. As the risk is increasing, bank need to keep higher reserve. Now, the ultimate objective is to keep higher reserve, to keep all the other investors, customer money safe, because bank, if come into a stress situation, they should be able to help the normal customer. Okay. Now that is something I have mentioned here. IFRS 9 is a accounting standard framework used by banks to estimate expected future credit loss. Credit loss is something you should understand on loans and financial products to decide how much loss reserve the bank should keep. Okay, and it's mainly used for SICR reporting and staging approach. What is SICR? I will come in later. Okay, I will come to that. So SICR is a very important approach that makes a huge difference in CECL versus IFRS 9. So we'll talk about that in a while. Now let's take an example to understand IFRS 9. So in this example, let's consider we have a customer called Rahul. So we have a customer Rahul. Suppose Rahul takes a home loan from the bank. Now Rahul is a customer of mortgage, the home loan, right? Now, if I talk about stages, so let me talk about the stages particularly. Let me make it a bit clean. Let's quickly do that. So, Rahul has come to the system. Let's talk about the implementation of IFRS 9 in stage-wise manner. So what is stage 1? Initially, Rahul is paying all the EMI, everything is going good on time. So the bank treat him as a normal customer and keep a small reserve for him. Okay. They don't consider that they should keep a whole amount. So let's say the loan amount was 1 CR. So the bank will consider that he's able to pay the EMI. They will be keeping some small percentage of buffer, let's say 4%. So they'll keep like 4 lakh as a buffer. But now stage 2 happens. After a few months, Rahul start missing EMIs. Here is the catch. His credit score start dropping. Now the bank feel the risk has increased, so the loan move to stage 2 in IFRS 9 and the reserve amount increases. The percentage is now not 4%, it will be increased to let's say 8%. So now 8 lakh rupees is something bank will keep. Bank has already calculated the probability of default for the lifetime in stage 2. Initially at stage 1, they calculated the probability of default for only 12 months for Rahul. Now they have calculated in stage 2 and stage 3, they calculate the probability of default for the lifetime of Rahul as a customer. Now the bank feel the risk has increased, right? So the loan has been moving to the further stages in this. Now stage 3, when the stage 3 will come, if Rahul stop paying completely because of any reason, they have lost their job because of COVID kind of scenario or any financial crisis, and become close to default, the loan moves to the stage 3. Now the bank keeps as much as higher reserve because the chances of loan default are very high. Now let's say during that, till the time Rahul came to stage 3, he has paid let's say 20 lakh out of 1 CR. Now this rest of 80 lakh plus the interest. That is something bank will try to keep it as a buffer. At least try to. Bank cannot do that because that's a huge money. But bank will try to minimize the losses. That's where this whole picture of IFRS 9 framework comes. It's an accounting standard. It's not a simple model. Don't get confused. Okay. Now that was all about IFRS 9. Now let's move to CECL. It's much more simpler. Okay. See, CECL is not an accounting standard. It's mainly used by only US banks. Number 1. It's not used outside US widely. Some of them would be using it, but not very widely. It's not used widely. Okay. So the moment you give a loan, estimate the total expected lifetime loss on the day 1 itself. So there is no concept of stages. So in CECL, on the day 1 itself, you will do the calculation of lifetime loss by Rahul. There is no staging concepts involved. So that is the huge difference. That's the biggest difference. Now, what does CECL actually do? So CECL basically directly estimate the total future expected loss of the loan. What does that mean? What does that mean? It means even if the customer looks perfectly fine, they have a very good financial situation, they have very good financial score, still bank will calculate the expected credit loss. The bank will still calculate possible future immediate losses which can happen. Okay, that is why CECL is considered as a more forward looking approach compared to IFRS 9. IFRS 9 works in the stage manner. Now simple example of IFRS 9, let's take again, let's assume that suppose one of the US bank has given Rahul a personal loan. Even if Rahul has a good salary, they will check his salary, his financial status, how much money he has in his savings account. Everything is good, like good credit score, no missed payment history. The bank will still estimate over the entire life of his loan how much loss can happen in future. So instead of waiting for the risk to increase compared to IFRS 9, CECL calculate lifetime expected loss on day 1. That's the whole concept. That's the whole and soul of these two. Now, that's what I have mentioned here. CECL is a US accounting framework where bank estimate total lifetime expected loss in the beginning of the loan. It's not as widely used compared to IFRS 9. It's a whole accounting standard followed by a whole world almost, while US focus on CECL and IFRS 9 secondary. They focus on both obviously, but CECL is more forward looking, so they are more inclined, most of the banks. Now, easy difference between IFRS 9 and CECL if you get confused. So IFRS 9 reserve it only reserve. It basically try to help you stage wise. Reserves increase when customer becomes risky. That's the game here. Now in CECL, obviously, even if the customer is risky or not, I don't give a damn. Lifetime expected loss is estimated on the day 1 of the customer. Okay, that's the main difference. Now let's talk about the main differences overall, which can help you in your next interview. Okay, I hope all of you can see it properly. Now, there are so many things we should talk about in IFRS 9 versus CECL methodology difference. So let's talk about them. Just let me pick up my pen here and then we'll talk about them quickly so that we can mark also if something is important here. Okay. Now, there are so many area-wise differences I have calculated here. So we are talking about the applicability. What is applicability? This means that the portfolio or geography, the framework is used for, like which particular one it is used for. That is applicability. Then SICR concept, right? SICR stands for significant increase in credit risk. So SICR concept, basically it helps identify whether the borrower credit risk has been significantly increased over a period of time or not. Now, staging means categorization of loan based on the credit deterioration. Simple. Then what is PD model? On the basis of the PD model, we'll talk about the difference. So probability that a borrower will default. Simple. Then payment frequency and amortization delay. So basically it handles timing of repayment and loan amortization. If you want to understand amortization, just Google it. It's a simple concept. Okay. Because if I give you here, then you'll get confused in these two. Then amortization types. Now, this defines how loan principal will be repaid over period of time. So, we'll talk about the difference later. So, but it talks about the repayment behavior, right? Then we'll talk about the CCF concept. So, converts off balance sheet exposure into expected utilized exposure. Simple. Then LGD and term buckets. So, basically segmentation used in proxy and loss estimation calculations. Then we'll talk about the boutique TF proxy. So specialized proxy methodology for some portfolio products. And also guys, if you want to download this file, I'll put it in the GitHub. You can download it from the description. Now let's talk about the differences on the basis of all these area in IFRS 9 versus CECL. So on the basis of applicability, it is applicable to US and Canada or the whole globe basically. But CECL is only applicable to US portfolios basically. US market follow this. So US is something who's following this forward looking approach. They're focused on this. Then for IFRS 9, SICR exists, but there is no concept of SICR. Then here you have stages concept in IFRS 9. In CECL, no staging concept. In IFRS 9, PD can be conditioned and unconditioned because you have staging concept again. And here PD is only conditioned for all the portfolio who are based out of United States of America. Then payment frequency and amortization delay are very limited concept. They are not much used in IFRS 9. It's explicitly handled in CECL modeling. Okay. Then we'll talk about amortization type. So here are only bullet and amortization loans basically. While if you talk about CECL, they have like bullet, linear, delayed linear, fixed principal and so many cash flow concepts. Now let's go down a bit. So we'll talk about LGD and term bucket. So in IFRS 9, it is not used. Not as a concept, it's not implemented there. While it is used in CECL. And then this boutique TF proxy, which talks about the proxy methodology for some products or portfolio, it is not at all used in IFRS 9 while it is used in CECL. So this is the main core actually. There are not more differences. If you talk, these are the core differences, most important differences which you should know between IFRS 9 and CECL. Now let me talk about a couple of quick things for your next interview. Okay. So if somebody asks you the difference, so IFRS 9 increase reserve when credit risk increase while CECL estimate lifetime expected loss on the first day of the loan. That is something you should tell. Now, how you will narrate the story in your interview, that is something is important because this is a very importantly asked interview question. So you should always frame your words in a way that IFRS 9 and CECL are accounting framework used by banks in across the globe. CECL is only used in US. For expected credit loss calculation, IFRS 9 use SICR concept because significant increase in credit loss, and staging concept to decide whether 12-month or lifetime loss should be recognized. Simple. While CECL directly estimate lifetime expected loss on the day one of your loan disbursement. So that's the main difference. I hope if this video makes sense to you. If you have any question, concern, please put your question in the comment section. And if you like my effort, if you like this video, please make sure you subscribe to my channel. This is very important concept for your next interview, and all the best for your next interview. Thank you so much.